I am more hesitant to deal with highly regulated businesses where one civil servant can decide whether a very large company lives or dies based upon a perception of social good and without any respect for owners. In fact, the Fannie Mae and Freddie Mac situation made me think that ownership is becoming an illusion in highly regulated companies.
Why his famed Fairholme Fund is now more than 80% invested in just one stock.
Funding provided by ClearBridge Investments, First Eagle Investments, Royce Investment Partners, Baird, Matthews Asia, Strategas Asset Management, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. In the world of value investing, this week's guest has been considered one of the best. He is Bruce Berkowitz, founder and chief investment officer of Fairholme Capital Management, where he launched his flagship Fairholme Fund in late 1999 at the top of the tech bubble. The Fairholme Fund rose to fame by delivering better than 13% annualized returns in its first decade, putting it at the top 1% of its Morningstar large cap value category and crushing its peers and the market. By 2010, Berkowitz had been named Morningstar's first ever domestic equity fund manager of the decade, its 2009 domestic stock fund manager of the year, and had been given the professional distinction of writing an introduction to a chapter in the 6th edition of Security Analysis, Benjamin Graham and David Dodd's classic value investing Bible, which had a foreword written by Warren Buffett. Investors took notice. Fairholme Fund's assets climbed to a peak of $20 billion plus by 2011, only to fall 70% to $7 billion by 2012. The reason: the fund's 32% drop in 2011 and its huge concentrated positions in a handful of controversial stocks, which led to massive redemptions. Among Fairholme's controversial and very concentrated holdings over the years have been insurer AIG, which made up more than half of the portfolio at one point, Bank of America, retailer Sears, and the preferred shares of government-sponsored entities, Fannie Mae and Freddie Mac, which were placed into conservatorship by the U.S. government in 2008, and despite being enormously profitable, remain there. Since inception, the Fairholme Fund has had impressive results, total annualized returns of nearly 10%, beating the S&P 500 by a wide margin, but its performance has been volatile, going from the top of its class one year to the bottom the next. And it has gotten even more concentrated over time. Today, the Fairholme Fund's assets are down to $1.2 billion. The Berkowitz family is the largest shareholder by far, holding more than 30% of the fund, and 82% of the fund is concentrated in one stock, Florida real estate developer and manager, the St. Joe Company, and the fund is once again outpacing the market by a sizable margin.
My investment approach since day one has been to count cash. Been fairly successful in doing that. At the end of the day, the investment equation is, what you pay versus what you receive. And part of that equation is to understand the assets and liabilities of an investment, of a company, to understand what those assets will eventually be redeemed for, how much cash the assets will generate over time.
What attracts you to a company in the first place?
The money that the company generates. Hopefully it's simple to understand. It hasn't always been, but it's really just the cash generation and hopefully fewer variables so that I can stay with an investment for a very long period of time.
And you've had a history of investing in financial companies, for instance, and more recently, real estate companies. Are there certain sectors that tend to be undervalued?
Well, yes, undervalued, but also it has to be within my circle of competence. I should have some understanding of it so that during tough times, I won't be shaken loose from the investment. And yes, I had very successful investments in banks from the 90s through the last Great Recession. It sort of all worked well until it came to Fannie Mae and Freddie Mac preferred. In the end, it was as expected. Fannie Mae and Freddie Mac ended up earning hundreds of billions of dollars of tremendous social value to homeowners, low-cost, fixed-rate mortgages, which a lot of homeowners are benefiting by right now. And it did as I expected to do. But for social reasons, the companies were put into federal conservatorship. They were taken by the United States government. And even though they have earned hundreds of billions of dollars since then, they're still under federal conservatorship, and the government won't let go.
They still originate, what, 90% of the mortgages in this country? Is that the case?
Yes, $6-7 trillion of assets. They're
Right.
publicly traded, but they've been pushed to what we used to call the pink sheets. And they were taken off every major exchange, and it's very difficult to see the trading. So yes, and there have been many lawsuits, and sadly, legislators, politicians have agreed with the government. The judicial system has agreed with the government over the conservatorship. The Supreme Court agreed. Recently, we had a trial by jury on the issue of whether the government acted in good faith and fair dealings. And a jury of regular citizens decided that, yes, we were wronged, and gave Fannie Mae and Freddie Mac shareholders a $600 million settlement. Now that is not, it's a big number, but
Right.
it's not big compared to the $34 billion of preferred stock that was taken. So Fannie Mae and Freddie Mac were not a good investment, still are not a good investment. It still is to be determined whether or not it remains a bad investment, in that I've spent 10 years of my life on Fannie Mae and Freddie Mac. We shall see. It's still to be determined. I'm not holding my breath. In the financial environment that we're in now, with interest rates going up 500 basis points and a lot of financial services companies facing significant stress with their assets and deposits, and also insurance companies, I'm happy to see that Fannie Mae and Freddie Mac are doing quite well.
I have to ask you, because you were not alone in recognizing Fannie and Freddie's, financial attributes. Carl Icahn was an investor, Bill Ackman was an investor, but you hung in longer than they did. They finally kind of threw in the towel. Why did you stick with it?
I was naive about the government doing what's right. These are two companies that didn't need a bailout, didn't need to be in conservatorship, always had a tremendous amount of cash, quite profitable, a history since the Great Depression. And I thought that there was just a mistake was made by the government as to taking them into federal conservatorships. And I thought over time that would be reversed. After all, how can you still be in a conservatorship after making hundreds of billions of dollars? But I guess if you're in a federal conservatorship and the United States Treasury is getting your money, then you can, it becomes Alice in Wonderland. Left is right, blue is green, and it's going to be up to either the courts or the legislature to decide that enough is enough. Not a happy ending so far. And as I say, I'm not holding my breath on it, and we've moved on. But it
Right.
should have been a wonderful win for shareholders and for the country. And maybe one day it will be.
What are the lessons that you've drawn from that experience?
I am more hesitant to deal with highly regulated businesses where one civil servant can decide whether a very large company lives or dies based upon a perception of social good, and without any respect for owners. In fact, the Fannie Mae and Freddie Mac situation made me think that ownership is becoming, an illusion for in highly regulated companies. This is exactly what Fairholme has done with Wells Fargo, Bank of America, AIG, Goldman Sachs, Regions, Financial, many other companies where our shareholders stepped in to support financials during difficult times, and those financials came back.
Right, you benefited from many of those, right?
We all benefited.
Right.
The companies benefited from the support. Our shareholders took a risk and received a reward, but not with Fannie Mae and Freddie Mac. And I hesitate now to invest in the banks and insurers today because there are many that could possibly face the same issue as Fannie Mae and Freddie Mac. Interest rates have gone up significantly. That means the loans on their books are worth much less than when they were originated. If you received a 3% loan from Bank of America, well, who's going to buy that loan at a 3% rate when people are going to require 8 or 9%? And what is the implication for the valuation of that asset or for an investment security based on that mortgage? It's going to take years to recover from holding low interest fixed rate loans and investments. And at the same time, the funding source for banks are deposit rates. I mean, it's time now for depositors to earn some interest on their money.
Right.
Especially when the United States Treasury will pay you 5% for 1 month. And I think many banks are forced to keep their deposit rates low because they can't afford to fund their 3 or 4% loans with 5% deposit money. So luckily the rules have changed somewhat, so it's not obvious. The balance sheets of many banks are not obvious as to what their true value is, their mark-to-market value. As long as it stays this way, they should be able to recover over the next few years. But if interest rates continue to go up or the government changes the rules as to how you value a loan or a security, there could be some real issues. Now, of course, there are always exceptions to the rule, and there are financial institutions that prepared for higher interest rates, more normal interest rates, and those institutions should do quite well.
So any for instances?
A Berkshire Hathaway, keeping $100 billion plus in T-bills, earning nothing. W.R. Berkley, another insurance company that took the pain of holding on to significant liquidity at a time of zero rates, and now has the ability to reinvest to reinvest at 5% or to reinvest that money without a loss at much higher rates, 9, 10%. So yes, there are winners, and I'm starting to look at smaller banks and financial institutions where the management had the courage to sort of suffer, to earn less yesterday in order to earn more tomorrow. And they're usually owner-oriented management teams, managers that have a significant amount of their family net worth in the institution. So they were more focused on not losing rather than getting a short-term performance compensation based upon yearly or quarterly earnings.
I'm reminded of some of your famous Bruce-isms, and one of which I've quoted many times on Wealth Track over the years, which looking at cash as financial Valium. And do you still feel that way? And what is your position in the Fairholme Fund now? Is what, about 12% cash?
We're about 13% in
13?
cash.
Okay.
And our income fund is at 67% cash. And
wow.
we're up 10% for the year versus a negative return for the Bloomberg Bond Index.
And the Fairhome Focused Income Fund, why is it 67% in cash? Is that because that's where you find the best income, is in cash equivalents, T-bills?
Exactly. There are a few investments I can find for good income, but overall, the T-bills make a lot of sense. We have found one excellent income-earning investment, a company called Enterprise Products. Enterprise Products is a pipeline company. Basically, they have a $75 billion of irreplaceable energy infrastructure. Call them toll roads. They take oil, natural gas, petrochemicals from where they are produced to where they are needed. We can't live without natural gas or oil. 96% of all the products that we use have petrochemicals in them. You know, find a medication that doesn't have a derivative of natural gas or oil in it.
Right.
Enterprise Products moves the basic energy blocks and the basic petrochemical products to where they are needed. They have a wonderful 25-year history, and they've averaged about 15% per annum return, of which half has been cash distributions. So at this point, I'll tell you, it sounds too good to be true, which will invoke my next principle of there's no such thing as a free lunch. It's either not free or it's not lunch.
So,
Enterprise Products is a master limited partnership, an
Right.
MLP. When you buy an MLP, you're buying into a business, and it's taxed as an operating business. It has different tax attributes, some of which are quite positive, than a regular equity or a bond. So it's complex. You have to study it. It's not right for, say, retirement accounts. It works quite well for Fairhome funds, but it's the largest position in my income fund. And the income fund acts as a sort of a blocker. So shareholders of the income fund do not have to deal with the issues of an MLP and K1s.
So Enterprise Products is your one investment for a long-term diversified portfolio.
Enterprise Products would be the one investment to make, especially for those who desire cash income. 7.5% distribution. It's returned 15% per annum for the last 25 years. They are positioned to earn 15% per annum for the next 25 years.
Talk to me about kind of the evolution of the portfolio, because as we mentioned in the introduction to you, at one point you had $20 billion under management.
Yes.
You won all of these awards. And if an investor had stayed with the Fairhome Fund since its inception, the returns would still be beating the market, the S&P 500, by a very wide margin.
Twice the performance of the S&P 500 since 2000.
So the journey, however, for many investors has been really difficult to stay with. You own several companies, for instance, over the years, and now you're basically down to just a couple, and especially the fact that the St. Joe Company now constitutes more than 80% of the Fairhome Fund portfolio. How did you get from owning more companies to focusing 82% of the portfolio in one?
It's a great question. St. Joe was a 3% position in the fund when the fund was a $20 billion assets under management. Today, the fund has $1.3 billion under management, sort of back to the future. And even though I have sold probably over $200 million of St. Joe over the years, because I stopped buying St. Joe in 2010.
Wow.
And the position was established in 2010. It was my last purchase it's probably 3% of the fund. Now, over time, as shareholders decided to move on, given the volatility of the fund, the relative poor performance, the fund has shrank. And so today, I and affiliates of mine own 34% of the fund shares. So today we have a situation where the fund now owns 1/3 of St. Joe.
Right, the largest shareholder, right?
Yes.
Yep.
And my family own 1/3 of the fund. And I'm also the chairman of St. Joe. I learned from Sears that if you're going to have a big position, you better be in a position to defend that position.
And the lesson from Sears, because Sears, again, the reason that you bought Sears and took such a large position in it was not because of the retail business, it was because of the real estate, right?
Yes, it was from day one. I thought that Sears had the potential to be the world's largest real estate company.
Right.
History has shown from the ashes of failed retailers came great real estate plays. So I thought it was quite simple. Stop the retail, use the cash to redeploy the cash to the real estate. I was unable to convince management or the board, and
Right,
I did
Eddie
go on the
Lambert.
board for a couple of years.
Right.
I was the only one. No one bought into it, and I think it's obvious that that was the way to go.
Right.
And St. Joe is an example of that, where a focused real estate strategy of generating cash, keeping your leverage low, being in a position to last, that is, to weather all environments, you can do quite well. And the company is in a very good position today because of what I would call the great migration south. Florida is now the third largest state by population and has surpassed New York State. Florida has the fastest growth rate. And then if you look at Northwest Florida,
Which is where the St. Joe company is.
and Northwest Florida is growing much faster than Florida. So St. Joe on the Gulf of Mexico, surrounded by the ocean, surrounded by the intracoastal waterways. Think about if you took Tampa, St. Pete, Sarasota, and threw in Orlando into a contiguous space in Northwest Florida, that's what you have with St. Joe. And St. Joe is taking that land and developing it for homes, has entitlements for 170,000 homes, dozens of hotels, apartment buildings, resorts, clubs. And St. Joe owns the land free and clear, purchased decades ago. You have land that's priced at less than $20,000 an acre. And then if you look at transactions in the area, like what people pay for land to build a home or to build the next hospital or school or a shopping center, a golf club, it could be up to and surpass $2 million an acre. And that's the opportunity at St. Joe. And that's the reason why St. Joe's earnings have been growing so fast.
You are continuing to look for other companies to invest in. It's just that you haven't found the compelling values in recent years that you used to find.
I'm looking every day. I'm a bit more conservative than I was before. I continue to look for that great long-term investment. And I believe I found it in St. Joe, because after all, sort of real estate seems to be one of the few areas where families have multi-generational success.
Thank you so much, Bruce Berkowitz from the Fair Home Funds. We really appreciate your being on Wealth Track again.
Thank you, Consuelo.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is understand who you are investing with. The experience of many Fairholme Fund investors is a case in point. Bruce Berkowitz is a deep value investor who has a history of taking really large positions in a few unpopular, even vilified stocks. He is able to handle the inherent volatility of his approach, but most investors can't. When his positions are working, investors rush in. When they don't, investors rush out and end up with losses. The expression know thyself can be modified to know thy investor as well. Next week, our focus is the state of interest rates with financial thought leader Jim Grant, publisher of his influential Grant's Interest Rate Observer, now celebrating its 40th anniversary. In this week's extra feature, Bruce Berkowitz shares how he handles major financial setbacks like the unsuccessful attempts to save Fannie and Freddie stockholders. Please follow us on Facebook and our YouTube channel. Thank you for spending time with us. Have a lovely weekend and make the week ahead a healthy, profitable, and productive one.